Hey guys, welcome back to DCA. If you're new here, my name's Jay, and what we do on this channel is detailed, data-driven analysis of the cryptocurrency asset class. It's my goal to bring institutional-grade analysis to the retail investor, allowing you to make more informed financial decisions. There's no hype, there's no hopium, and we're only looking at the data. So today I want to talk to you about the DeFi and smart contract industries, which have seen exceptional growth in 2021 and 2022. With many institutions, such as the World Economic Forum, expecting the DeFi space alone to grow into the tens of trillions of dollars in the coming years and decades. However, more specifically, I want to discuss an asset which forms the entire backbone of these industries, one which has such a stranglehold on its niche in this market that there isn't a single legitimate contender it's competing with. So today we're going to be talking about Chainlink. So before we get started, if you guys like this type of content, don't forget to hit like and subscribe. I'll actually be uploading a more in-depth report on the Chainlink network. However, in the report, we'll be going much more in depth. This will be available in a week or two. You can sign up for this for free on the Discord. There's a link to that in the description below. So there's a ton to get to, so let's jump in. So Chainlink was first launched in 2017 by its founders Sergey Nazarov and Steve Ellis. The parent company for Chainlink is a for-profit company, Chainlink Labs. The mainnet for Chainlink went live in 2019. So what exactly is Chainlink? Well, most smart contract platforms are located on individual blockchains and cannot natively integrate external data feeds. So this would mean that smart contracts are unable to react to off-chain world events. For example, prices of various cryptocurrency assets on exchanges, weather or sporting events, stock prices, etc. So anything that you can think of that happens in the off-chain world, this needs to be imported to the platform via an outside data feed. So Chainlink solves this issue with its network of decentralized data providers, otherwise known as oracles or nodes on these oracles. The data which Chainlink provides is actually not from a single source. It comes from a collection of sources, and that's going to be key. So that makes this data decentralized and much more resistant to corruption compared to a platform receiving a data feed from a single source. So data service providers are incentivized to provide accurate data to the Chainlink network by being rewarded with Link. So we'll be going into this much more in depth later. However, Chainlink actually does much more than provide decentralized off-chain data to smart contract platforms. And I'm just going to touch on this briefly here, and then we'll talk about this also a bit in depth later. So Chainlink provides verifiable random number generation, off-chain computation, a smart contract automation feature known as keepers, and perhaps most excitingly, if they can actually pull this off, is something known as cross-chain interoperability protocol, or CCIP. So to perform our analysis today, we're going to be utilizing a new asset valuation tool I've developed in order to help us visually understand how the asset stands up in terms of technology, how it's being viewed by the market against its competitors, particularly with respect to adoption, how much hype there is around the project, as well as the tokenomics, and finally, we're going to perform an in-depth market analysis and price prediction. So we've touched briefly on what exactly Chainlink does from a technology standpoint. However, what we want to know as investors is where does Chainlink stand up against its competitors? And quite frankly, with respect to Chainlink, it's unique in this regard, in that there are essentially no competitors. We can look at the evidence for this in multiple ways. So let's start by looking at the market cap of Chainlink compared to other Oracle networks. Chainlink boasts a nearly $8 billion market cap, with its nearest competitor coming in at around $500 million. The remaining Oracle networks combined account for barely over $1 billion. So these combined are worth about a seventh of what Chainlink is worth. If we look at the project integrations, we can see that Chainlink comes in at over 1,200, where the closest competitors are at less than 100. So we can also look at how rapidly the protocol has been bringing in new Oracle networks with unique datasets, growing from around 140 in Q4 of 2020 up to nearly 800 in Q4 of 2021. And in March of 2022, we're sitting at around 900. Now, the next point I want to discuss is going to be central to our discussion today, and that's the concept of total value secured. So total value secured, or TVS, is essentially a measure of how much value the Chainlink network actually secures in decentralized finance protocols. So this is essentially a measure of how many networks Chainlink secures by providing accurate and reliable data feeds. And recall, as we said before, a large part of the value that Chainlink brings is by node operators providing fast and accurate data, and then they are rewarded with link tokens in return for this data delivery. So naturally, as your total value secured increases, so too will the demand for link tokens, as the networks requesting the data will need link to pay for these data feeds. So now we can see that currently there's approximately $225 billion in total value locked in DeFi projects, and this has been as high as around $260 billion back in December of 2021. However, the more important point to note is that even though the crypto market itself has been depressed, basically dating back to May, the DeFi market continues to grow rapidly. So in order to understand the potential future value of Chainlink, it will be critical to understand the potential for the DeFi market, which is still relatively unknown or unused even amongst crypto investors. So if we look at Oracle networks, we can see that according to DeFi Llama, Chainlink controls approximately 50% of the Oracle space. However, this is a vast underestimation for two primary reasons. First, you can see that internal Oracle networks make up approximately 50% of the total value secured, meaning these networks utilize their own Oracle. However, if we look deeper into this, we can see that Anchor Protocol accounts for nearly the entire internal Oracle segment of the market. Now, this is important because in December of 2021, Anchor Protocol experienced a feed failure, resulting in $37 million in false liquidations. Shortly after this, a governance proposal was put forth which passed, which was to make Chainlink their primary Oracle feed. And this is a perfect example of why Chainlink is so critical to the crypto space. Inaccurate price feeds are an unacceptable risk for institutions attempting to enter the space. So having an enterprise level solution such as Chainlink is going to be absolutely necessary. Now, the last thing we can look at in terms of adoption is from the standpoint of development. We can see that development for Chainlink is rapidly growing, reaching an all-time high in 2022, while competitors such as Band Protocol are actually experiencing less development. Now, sometimes numbers like this don't carry a lot of weight, but in this case, I believe it does. Chainlink has over 350 employees and is hiring something on the order of an additional 200, whereas Band Protocol has around 20 to 25 employees. So to summarize this, essentially, Chainlink is such a dominant force in the Oracle space of the cryptocurrency asset class that there is almost not even a point in mentioning competitors. So with regards to technology and adoption, I think it's fairly obvious that Chainlink deserves a 10 out of 10 in both of these categories. Now let's move on from here to the tokenomics. And I want to stress the importance of understanding the tokenomics in any investment that you're going to make, as I feel like this is vastly overlooked by crypto investors. Remember, your actual market cap can be skyrocketing. However, if the market is being flooded with tokens, the price may not even move. So understanding where the tokens are and who holds them, how they're being distributed, is absolutely critical to your understanding of your investment. So it's important to first note that there is a maximum supply of 1 billion tokens, which were all minted at launch. Of these tokens, 35% were sold, essentially putting 350 million tokens onto the market. So 30% were allocated to Chainlink's parent company, so 300 million, in 6 separate wallets, each containing 50 million link. 35% were placed into a node operator incentive wallet, and we'll talk about this particular wallet later. So you can see that from this initial pool of 300 million tokens, which were assigned to founder wallets, there are approximately 183 link remaining in those wallets, indicating that the dev team has sold about 117 million link. These appear to have entered circulation around October of 2020. However, there's some evidence to suggest that these tokens started to move from these wallets much earlier than this. In fact, it looks like a small portion was moved as far back as 2017. So there are also a few things we can take away from these charts which demonstrate the increase in circulating supply over time. First of all, we see that once the bull market got kicked off in October of 2020, we started to see these link tokens move. And you can see that this was done in a very continuous and directed manner after an initial bolus of nearly 40 million Link tokens were put onto the market in October of 2020. Now, at the time, people were acting like this was somehow a scandal. However, in my opinion, this is only logical for the dev team to have done this. So they need to raise money in order to continue development of the project. And they do this by selling Link tokens. So we can see that this pattern of token distribution continued essentially all through 2021 and stopped in December of 2021. Now, this either means that one of two things occurred. Either they had a scheduled release through 2021, or they stopped selling tokens at the end of the year because of the price drop. Either of these options to me seems plausible. Now, this should also start to explain a few things about the price action. And relatively, the price of Chainlink throughout 2021 was rather tame, while many assets were experiencing massive moves during the same time. In fact, we see that the price at its peak went up around 5x from November of 2020. If you look from our price peak in May of 2021 through February of 2022, we saw that the TVS actually remained stable in spite of the massive price difference. And I think this is a critical point that we need to discuss today about the dynamics of the Chainlink token as it exists currently. So fundamentally, we need to realize that the value proposition of Chainlink is extraordinarily unique and completely different from any other asset that people are investing in. So to do this, let's think about how an asset like Ethereum is valued. And this is rather intuitive. Individuals using the Ethereum network require Ethereum or ETH to transact on the network. So we can fundamentally think of Ethereum as being valued by its number of active addresses. In other words, the more people using the Ethereum network, the more demand there is for the network. So we combine this with the total number of speculative investors, and combined are able to roughly estimate where the price of Ethereum may be. However, Link is completely different in this regard. Link can be thought of as an institutional token for several reasons. First, as an individual retail investor at present time, you have absolutely zero use for Link. Link is used to pay node operators for data feeds for use in blockchains, amongst some of the other uses that I previously discussed. So things like VRF or random number generation, off-chain computation, etc. So this basically means that other than speculative investment, there is no reason to hold Link as a retail investor currently. So this has created a unique demand structure for Link because we know that the demand is primarily coming from A, node operators who may need to collateralize their Link, and B, the networks who are utilizing the data feeds provided by the node operators. So if we look on these active address comparisons of Ethereum, Bitcoin, and Chainlink, you can see that there's a substantial difference here. And this is entirely to be expected based on what we've just mentioned. So essentially, much different than other tokens or coins, active addresses is a near useless measure of the true fundamental value of Link, and actually huge short-term spikes in this value represent nothing other than speculative investment. And as we've seen time and time again in the cryptocurrency market, speculative investment is transitory, and these users will go just as easily as they came. So these are nothing more than short-term price moves. So basically, we have a position where in times like May, we are in a heavily speculative dominated period for the asset. In times like February and early in March, these were essentially protocol dominated, meaning only users of the actual network were driving demand because the active addresses were way down during that time. So you can see on this chart, for instance, the monthly active addresses has fallen below 50K per month, while the active addresses back in May was over 250,000. So the market cap per active address has, however, continued to rise during this time. So this is demonstrating that much of the market cap and price value earlier in 2021, during the heights of the bull market, this was simply derived from nothing, like we said, other than speculative investors. Now here we can see the market cap as a function of total value secured. And we see that since late in 2021, this has reached closer to an equilibrium value between 0.25 and 0.125. So that's going to be market cap per total value secured. And this reflects where the market cap may be expected to be at, given any level of total value secured during the current market situation. And that's, again, a key point during the current market situation. So this is going to be value of the network derived from actual users, i.e. the individual networks that are paying the node operators. So you can think of the market for Link in its current state as a fundamental value. Where we're at right now can be thought of as the fundamental value because there is not much speculative investment right now. Now, this may all sound bearish superficially, but I assure you that it's not, and I'm going to explain why that is. So we've explained how the current demand structure is composed for Link, where demand is driven by short-term speculative investment, and more importantly, by networks utilizing the Chainlink network, requesting data feeds, random number generation, off-chain compute, etc., from these node operators, as well as to a small degree by node operators themselves who may need to collateralize Link. Now notice I keep suggesting that this is demand currently, and this is critical to our discussion today. You may or may not be aware, however, in 2021, the Chainlink 2.0 white paper was released, which published details regarding upgrades to the network, which will be released in 2022. Most important to our discussion today is Chainlink 2.0 and the resultant changes that will affect the supply and demand dynamics. So staking of Link alone merits a complete video's worth of discussion. However, I'm going to keep the technical points short here. And if you want to learn more, the complete report that I'm going to release on the Discord channel will have much more information about this. Again, we'll just focus completely on the market dynamics of Link staking and why this will be an absolute game changer. So essentially, Link staking will serve to vastly improve the security of the network. This will be via a mechanism known as superlinear staking. So essentially, if you have 10 nodes on an oracle, each with $1 million staked or $10 million total, a bad actor would then need to bribe every single node with $10 million in order to perform a successful attack. And this is because any individual node stands to be rewarded the staked amount of every other node who's misbehaving. So even if one node remains legitimate, the network is secure. This is the most basic way that I can explain this process. Now, more importantly, though, beyond the security layer of Link staking is our discussion today, which will revolve around what else beyond security does Chainlink staking bring? And to understand this, we must understand how a node operator is rewarded with Link. They'll be rewarded with two primary mechanisms. First, the nodes which develop the best reputation are afforded the opportunity to process more transactions and thus collect more fees. So how do you get the opportunity then to process more transactions? Well, this is via your staked quantity of Link. So in other words, in a sort of positive feedback loop almost, you stake more Link and then you get the chance to process more transactions. So when you process more transactions in a low latency, accurate, and reliable manner, your reputation score increases. So what we currently see on the Chainlink network is that the vast majority of node operators actually do process transactions in a reliable, fast, and extremely high accurate way. Therefore, what will the differentiation be? And it will all come down to how much Link that they have staked. And therefore, those that have more Link staked will have the opportunity to process more transactions and earn more fees. Now, this is absolutely critical to everything that we're talking about today because this fact completely changes the dynamic of how the Link token is viewed by these data service providers. We transition from a point where Link demand is essentially completely created by networks requiring node operator services and short-term speculative investors to a position where node operators themselves are actually going to be the ones who are going to be a primary demand source for Link. As it currently stands, in fact, the node operators themselves create heavy sell pressure because there's nothing that they can do with the Link. So they sell it in order to fund their operations. So we essentially will experience a complete 180 in terms of the Link demand side dynamics once staking goes live. So here you can see that in spite of the retail market essentially having left the asset class after May, you've seen the Link supply begin to fall after a short period of profit taking towards the end of 2021. And I speculate that this is the beginning of a node operator acquisition phase in anticipation of impending staking going live in 2022. In fact, you can see that earlier in March, about 6 million Link were pulled off exchanges all at once. It should also be noted that this will create a new demand structure for investors as well, not just the node operators. Once staking is live, lending your Link to a node operator for staking purposes will allow for both a speculative investment component to Link, but also an income earning component from retail investors. And this will inevitably increase the demand for Link from two components of the market, which are currently non-existent. So now that you understand the current and upcoming supply and demand dynamics, we will finally extend our discussion of this to the market potential for Link. So the first matter at hand is to obtain a better understanding of what the potential market for Link will be in terms of the DeFi market. And as we've seen before, the DeFi market as it is currently composed essentially completely relies on Chainlink to provide decentralized, secure, and accurate data feeds. Without these feeds, we've seen time and time and time again, networks fall to exploits. In fact, a network falling to an exploit is often how they decide to adopt Chainlink. So with all of that said, let's look at some projections for where the DeFi market may be. Now, this is looking at the total assets under management of banks. So the top 100 banks control around $100 trillion of assets under management. Now, this is a very conservative estimate, and this would say that if DeFi is able to capture 1% of the banking assets under management, that would put it at $1.25 trillion, given the current size of DeFi at around $225 billion total value locked, okay? Now, this 1.75 would be, a slightly more aggressive estimate, although this is still extremely conservative compared to what many estimates from institutions are suggesting that DeFi may be able to capture. So we're just going to use $1.25 trillion as a best estimate of where we may get to by 2025. Okay, now that we've established what we're expecting from the growth of the DeFi market, as well as the supply and demand dynamics of Chainlink staking, we can then begin to build a framework for assessing where the price may be going in the future. So first of all, let's just quickly look at this. So we know as total value secured increases, that means Chainlink will be securing more networks. In other words, more networks will be paying for more data. And we're expecting this to be proportional to the growth of DeFi. So in addition to that, what you'll see is as total value secured increases, liquid supply will begin to decrease. So as total value secured increases, this means by definition, you have more networks requesting access to the data. So they have to pay Link in order to receive that data from the node operators. So this just shows how total value secured then, as it increases, you will also expect the number of node operators to increase, because there will be more types of data requested. There will be more competition to be processing these fees, because remember, these data service providers are already providing this type of data. We still have a place where many firms are hesitant to enter into the crypto space for one reason or another. However, as regulation becomes more clear, as the space grows, as it gains legitimacy, you're going to see the number of node operators increasing, because there will be access to these fees and increasingly so that more node operators will be enticed to start offering data services on the Chainlink network. As the node operators then increase, you expect to see the free float of Link begin to decrease. Okay, so it's a positive feedback loop. So when we look at the other top assets that offer staking, you can see that typically somewhere between 35 to 70% of that asset is actually being staked. The reason why this is going to be actually, in my opinion, much higher for Link is because of the fact of how staking typically works. On most networks, when you stake, and when you stake more and more and more, we're talking about whale type staking here, so massive quantities. There's diminishing returns on staking. However, for Link, there's generally going to be the opposite of that, because you want to stake as much as you can in order to process as many of the fees on the network as you possibly can. As the link that you are staking increases, you're naturally going to have the opportunity to process more of the data requests, more of the data feeds that are coming through. You will have the opportunity to process more of those as you stake more. So you're incentivized to stake as much as you can, and it almost becomes a competition. It becomes a competition to see which nodes can stake the most Link, because they want to process the most fees. And as the DeFi space grows larger and larger, which we're anticipating that it will, and we're not talking about some sort of small growth here like we've demonstrated before. We're talking about massive growth into the trillions of dollars, even into the tens of trillions of dollars. So that's what's going to be, no pun intended here, that's what's going to be at stake. The amount of fees that can be processed is going to be absolutely immense, and it's going to continue to grow, and it's going to grow exponentially as we head forward. Now, there's one thing I want to point out, and that's that I think the effect of staking is, quite frankly, going to be overestimated in the short term. Because remember, DeFi as a space is still relatively, and we're using the word relatively, small. So I don't think there's going to be this massive influx of capital into Link in the very short-term timeframes. However, I think the long-term impact of this staking is being vastly understated. I think people are expecting that this is going to be just like any other staking protocol, and it will have some minor effect on the price on longer-term timeframes. I think the effect is going to be truly astronomical for Link. And when I say that, I'm basing that on the fact that you need Link as an infrastructure for the entire DeFi space, for the entire smart contract space. And infrastructure tends to not be a sexy investment, but it tends to be very, very valuable. And that's why you don't hear about this very often, because, people love to talk about transactions per second, things like this, time to finality. What Link is doing is behind the scenes. It's not for the retail investor. It's for the enterprises. It's for enterprise level investment. You don't hear people talking about Chainlink. So Link is not on a retail level scale. It's on a scale which impacts the entire backbone of the cryptocurrency and smart contract industries. And if you think that the metaverse, if you think that smart contracts, if you think that DeFi, if you think that these things are going to be the future of cryptocurrency, and if you believe in the future of cryptocurrency, which I personally do, if you believe in those things, then I think you really need to consider what it is Link is doing and why it's so important and why it's being so undervalued in those ways. When we're going to project what levels Link could potentially get to, we need to look at what the DeFi space is going to get to. Currently, that's at around 7.5%. But we're expecting that to continue to grow. Like we said, we're expecting DeFi to be one of the big players in the crypto space. Ultimately, I'm expecting, while I'm very bullish on Bitcoin, there's just too many other, great assets coming into the market with actual use cases. So I'm expecting the Bitcoin dominance to continue to slowly fall, and I'm expecting the DeFi dominance to rapidly increase like you're seeing. I mean, if you look since approximately mid 2020, the DeFi dominance has went from around 1.5, 1.25% up to where we're at now at 7%. And I don't anticipate this stopping short right there. I think we're going to continue to see these exponential rates of growth going into 2022, ultimately into, the next market cycle, or perhaps we do enter a more super cycle. Regardless of what it is, I expect DeFi to continue to grab tons of market share. We're expecting the value of Link, which if we come back and look at the Link market cap dominance, based on everything we've laid out, based on the fact that we expect DeFi to continue its growth, we expect the value of DeFi to be approaching north of $1 trillion by 2025. we're expecting the market share that Link owns within the DeFi space to remain fairly similar to where it is now. Remember, this is going to be infrastructure. When it comes to the security of your network, if you're actually serious about it, you don't go for the cheapest option. You're going for the most secure option. And we've demonstrated multiple times in this video, there isn't anything even close to being a competitor to Link. Link has something on the order of 300 to 400 employees, and they're hiring now somewhere between 200 to an additional 400 employees. So there's serious money involved with Link. And that means there's more research. We've showed the development of Link is increasing while the development of other Oracle protocols is decreasing. We've showed how there have been many breaches on other networks. So Link is gaining all the attraction, and that's going to continue. It's not going to suddenly decrease where your most secure, your safest, your most reliable option is significantly diminished in popularity. This is only going to increase. As these new protocols come in or protocols begin to get larger, you're going to continue to see Link being the network which is securing these transactions. Okay, so what's the bottom line? Well, we've looked at what effect staking is likely to have on Chainlink. We've looked at the expected growth rate of DeFi going forward. So let's take a look at what a projected price for Chainlink would be then, given what we know, given the constraints of the market that we've laid out. So this is a projected growth of the Chainlink market cap. So given what we know about the market cap of Chainlink per total value secured right now in its fundamental value state, we know that currently, under current demand conditions, Chainlink is being valued at approximately 0.13 up to around 0.25 per total value secured. So if we project that forward then, let's take a look at this diagram. This shows us in 2022 at $60 billion total value secured, Chainlink has a current market cap of $8 billion. So this is our fundamental value. And that is a market cap per total value secured of 0.133, like we said. Currently, there's a supply of 467 million. Now, the supply is a complete unknown. We don't know what's going to happen with the supply. So based on everything that we've said about DeFi, based on the fact that Chainlink is essentially the only Oracle, we're expecting the total value secured for Chainlink in 2025 to be somewhere between 350 up to $750 billion. And we're expecting that the market cap per total value secured is actually going to increase. And that's for all the reasons we've laid out, because there are going to be these new streams of demand for Link being formed as Chainlink 2.0 rolls out. And the supply we don't know then. So we have to have leeway in our calculation because the supply could go anywhere from 500 million all the way up to the complete 1 billion tokens that exist. So let's look at total value secured and look at the expected growth of the market cap per total value secured. And we're expecting that to go from where it's at right now at around 0.13 up to around 0.25 to somewhere between 0.2 and 0.3. Okay, so these are very conservative estimates for where the market cap per total value secured may go. So essentially it's already within that realm right now. So we're basically saying the bottom line might go up some and the upper limit may go up barely. So we have to account for the fact that we don't know how many tokens there will be. So we're saying between 500 up to 1,000 million or 1 billion. And based on these values with our expected total value secured for Chainlink, that would give us, depending on how many tokens there are and where the actual market cap per TVS falls, if we only were securing 350 billion, somewhere between a $70 up to $300 Chainlink. Okay, so these are bottom line figures though. These are the bottom estimates. If tokens all come out, all 1 billion tokens come out, that would give us a $70 Chainlink. Now, conversely, if total value secured actually goes up to somewhere near $750 billion, which I do think is entirely within the realm of possibility, and then we look at the market cap per TVS, being valued at around 0.2 up to 0.3. And again, we don't know the token supply. Well, now we're talking about somewhere between $105 up to $450. And I tend to think that, if you look at the entire range here, $70 up to $450, I personally believe somewhere around $150 to $200 would be a safe estimate for a total fundamental value for Chainlink in 2025. And like we said, we're laying this all out based on mathematical values here. We're not just pulling things out of the air. We're considering the demand structure. We're considering the DeFi market. We're considering the growth of these markets. We're even considering potential for the token supply being anywhere from 500 million all the way up to a billion. Now, remember, it can't go above a billion. 1 billion is the maximum number of tokens. And notice that there's an asterisk here at the bottom. And that's that these values exclude speculative investment, these FOMO phases in the market that you always see. They entirely exclude that. And they entirely exclude the effects that something like CCIP will have. If CCIP lives up to its potential, that could trump everything that we've talked about today. That could make Chainlink's data service a small portion of the value that Chainlink brings to the crypto network. And we'll talk about CCIP in another video, because at the end of the day, we don't know exactly what CCIP is truly going to be able to accomplish. So we're going to leave that alone today. So this value is assuming that all of Chainlink's value is essentially coming from its data services, from its Oracle service. So when you look at this, I think this makes a lot of sense. And I think that's why you're going to see Chainlink in the coming years start to move up the leaderboard, start to show that it's much more valuable than any individual layer one, save perhaps Ethereum. So, I think you're going to be looking at a position where we have Bitcoin, we have perhaps one or two top layer ones, and then you're going to need a top infrastructure play. And that's hands down, without a doubt, going to be Chainlink. There's not even, like we've said many times in this video, there's nothing even competing on this level. There's nothing competing in terms of quality. There's nothing competing in terms of research dollars. There's nothing competing in terms of size of the project. So Chainlink is, at the end of the day, the backbone of the entire smart contract and DeFi segment of this market, which is going to continue to rapidly grow. Okay, guys, so I just wanted to finish this up by going over the last 3 boxes in the digital asset index that we talked about. So as far as buzz goes, we're going to give that a 2. That's because not many people talk about Chainlink. Not many people are very hyped up about it. But that doesn't matter, as we've detailed extensively in this video. The retail market is not that important for Chainlink. This is an enterprise solution. Now, because of that, the retail market should be hyped up about this asset, but they're not, and that doesn't matter. So for tokenomics, we're going to give it a 5 because there's over 50% of the supply out there that we just aren't exactly sure what's going to happen with. So while it's not the best, given that there's a 1 billion fixed supply, we're going to live with it and give it a 5 out of 10. Now, as far as market analysis, which at the end of the day is the most important of all of these ratings, the market analysis for Chainlink is a 10. Based on everything that we've talked about in this video, the potential for this asset is absolutely astronomical. And I see it being a top 5 cryptocurrency, 5 years down the road or so. So that's going to be it for this one, guys. I hope you guys liked this analysis. A lot of work went into this. Remember, I'm going to be posting an institutional grade analysis for Chainlink, which is going to go even more in depth than we did today in this video on the Discord. So head over there if you're interested. And until next time, as usual, see you.